Good morning, traders, and welcome back to another daily analysis. I'm Adrian from BCR, and today I'll be bringing you the latest insights and key levels for the market. Today, I'll be covering dollar index, spot gold, Aussie dollar, and dollar yen. Let's get right into the action. First up, we've got the US dollar index. The US dollar softens its earlier gains on Thursday, trading flat or slightly stronger against most of its peers. Mixed US economic data has kept investors cautious ahead of Friday's key job reports. The US dollar index briefly touched 108 levels during European trading but failed to maintain momentum, retreating below this level. Market sentiment was influenced by geopolitical developments, including US President Trump's comments on Gaza, Iran, and Ukraine. Technically, the DXY remains in a downward correction. Early in the week, it attempted to break a 109.3 level but failed, signaling continued weakness. Key support lies between 107.35 and 107.31. And a break below this range could push the index further down to 107 or even 106.51. On the upside, though, resistance remained at 108, with stronger selling pressure preventing further gains. A break above 108.36, that's the 20-day moving average, that could open up a path to 109, though market uncertainty makes a sustained rally unlikely. Overall, the dollar's pushback aligns with recent trends as trade concerns ease and markets continue pricing out tariff risks. Investors remain focused on upcoming data and geopolitical shifts for further direction. Next up, we've got spot gold. Gold prices stagnated on Thursday as US Treasury yields rebounded and the US dollar remained slightly higher. Investors took profits ahead of the upcoming US non-farm payrolls report, which could introduce volatility. Spot gold traded at 28.55, consolidating after reaching record highs midweek. The surge in gold prices reflects ongoing global economic uncertainty, with investors favoring gold as a hedge against potential tariff impacts, inflation, and economic slowdowns. Loose monetary policies worldwide and shifting capital flows have further increased gold's appeal as a safe haven asset. On the technical side, gold remains in a strong upward trend with no clear signs of reversal. After breaking the historical resistance at 2800, this level now serves as key support. If gold holds above 2800, further upside towards 3000 remains possible. On the downside, though, a break below 2800 could see support at 2772. To maintain upward momentum, gold must close above 2882 to test the 2900 level, with the psychological 3000 mark as the next major target. Market sentiment remains bullish, but upcoming economic data and monetary policy shifts will be key drivers for future price action. Now we're going to shift to our forex pairs, and the first one we have is AUD USD. The Aussie dollar regained traction on Thursday after dipping to 0.6255 levels early in the session, stabilizing around 0.6280. The pair remains focused on key resistance near 0.63 ahead of Friday's US non-farm payrolls report. Australia's trade balance data disappointed, showing a surplus of 5 million in December, well below expectations of 7 million. Weaker exports and a sharp rise in imports contributed to the decline. Risk sentiment remains cautious due to escalating US-China trade tensions, limiting the Aussie dollar's upside. On the technical side, the pair maintains short-term bullish momentum, trading above both the 3-day average and the 20-day moving average. That's 0.6248 and 0.6238. The 14-day RSI remains above 54, reinforcing a positive bias, and immediate resistance lines at 0.6330, followed by 0.6366. And on the downside, support is seen at 0.6238 and 0.62. A break below that level, that 62 level, could shift momentum lower towards 0.6170. With the Reserve Bank of Australia expected to cut rates to 4.1%, traders will closely monitor US labour market data and further developments in China and how the trade war is going there. So that's going to have the biggest market move there. And finally, we've got USD JPY. The Japanese yen remained strong on Thursday, trading near a 2-month high of 151.2 before attracting intraday sellers. Market expectations of further Federal Reserve rate cuts and strong Japanese wage data have fueled speculation that the Bank of Japan may continue raising interest rates. The narrowing interest rates in differential between Japan and the US has increased demand for the low-yielding yen, while falling US Treasury yields have further pressured the USG JPY pair. As a result, the pair declined for the third consecutive day, reaching the 151.8 area, its lowest level since December 12th. On the technical side, the dollar yen outlook remained bearish after breaking and closing below key support at 152. The failure to hold above the 152.5 and 152.45 confluence confirms downside momentum. Further declines could test 151.5 and 151.56, with the key 150.6 and 150 zone as the next major support. On the upside, resistance lies at 152.5, with a potential short covering rally pushing the pair towards 153. A breakout above this level would shift the short-term outlook to bullish. Traders remain focused on the Fed policy expectations and US-Japan interest rate dynamics for further direction. Well, that's all, traders. That rounds up today's market analysis. Thanks for tuning in. Don't forget to like, share, and subscribe. Also, if you have any further questions, then don't hesitate to leave a comment below and I'd be happy to answer. I'm Adrian from BCR, and as always, good luck with your trades.